Are you a property investor looking to pay less in tax and keep more of your hard-earned rental profits? If so, you're in the right place. In today's video, I'm going to outline 9 of my favorite tax write-offs that you can claim in your property business to make sure that your corporation tax bill is as low as it can possibly be, because that's a good thing. It means you're paying less corporation tax and keeping more of your profits. Stick around to the end to make sure you don't miss any, because if you do, there's a good chance you'll be overpaying taxes. The first one that we'll cover is mortgage interest. So a lot of people are still not so confused about this, but they don't fully understand how it works when you're in a limited company compared to your own name. So if you've got a property portfolio in your own name, the default is that now you can't claim mortgage interest as a tax deductible expense. You basically calculate your profit, excluding the mortgage interest. Whatever that is, you will then pay tax on that. Effectively, they calculate how much tax you've got to pay, and then you'll just get a tax relief, effectively a tax credit, at 20% of your mortgage interest. Not many people are owning property in their own name now. For this very reason, they're going into a limited company. And the reason for this is quite simple. With a limited company, you can fully deduct your mortgage interest. And it doesn't just stop there as well. Arrangement fees are also tax deductible. And a lot of people miss this one because they don't actually pay the cash out. It usually gets added to the mortgage. And a lot of accountants miss this, unfortunately, which means you're missing out on valuable tax relief. But with the mortgage arrangement fees, what you need to do is look at the term of the loan. So if you've got a 5-year loan, effectively 5-year fixed rate, and it's quite reasonable that you as a director will remortgage in 5 years, get another competitive rate, then what you can do is basically amortise or write off that amount of arrangement fees. So if it's £10,000 arrangement fees over the 5 years, £2,000 a year, you can claim tax relief on in the limited company. If the mortgage arrangement fees, when you calculate this, are immaterial, so it might just be a couple of £100 that you've paid, then you can write the full amount off in the year when you take out the new mortgage. And then we have repairs and maintenance. A lot of people, again, miss this one. They might not claim for repairs that they've done. They might not claim for the power tools that they're using in their property business. Of course, it's a business expense. You're using it for the business to generate profits, to keep your tenants happy and ensure that they're paying their rents. But what you also need to do is, especially if you're going after the BRR, the buy, refurbish, refinance strategy, is you need to closely analyse your expenditure, because as you'll know, capital expenses, which is where you're basically improving the value of the property, you're making it better, or actually if it's so uninhabitable that it can't possibly rent it out and you've got to incur this expenditure to bring it into use, then that is considered capital expenditure, and you'll only get tax relief on that when it comes to selling the property. But if you buy a property that is, just pretty run down, but you could still get tenants in there, you might not get the top market rent, but you will still get someone in there, happy tenant. Is a bit of a dive, but that's how quite a few landlords operate, and that's their model. No frills accommodation. But if you do that, and then when you purchase the property, you might refurbish it, you might replace the kitchen, but like for like, you might put some new carpets down, whatever it might be. Well, actually, that is an allowable repair expenditure. The carpets are already there, you're just replacing them. So I'm going to pause the video here to make sure that if you haven't already, you have hit that subscribe button. Please give this video a thumbs up. But it massively helps the video get out there and impact as many people as possible. Back to the video. The kitchen was already there. You're just putting a new one in, but it's actually no better. The carpet still does the same function. When we're talking about capital v revenue, it's usually about the function. Well, actually, the carpet's still there, the kitchen's still there, the bathroom's no bigger or better. It might look better, but it actually does the same thing. You can wash your hands, take a shower, and go to the toilet there. So you need to look through your expenditure to make sure that if you are doing a BRR, that you're claiming as much as possible of that capital expenditure. That's not actually capital expenditure, but a lot of people think it is, and try to push for as much as possible to be revenue, so that it's offset against your rental profits now, and not in the future offset against the sales price when you come to actually sell the property in 5, 10, 20 years time, whatever it might be. So closely review your expenditure to make sure that you're putting for as much as possible as a repair, because if it's just a repair or replacement, it's an allowable expense and is going to reduce your profits. We've also got salaries, so paying yourself a salary, whether you're a business partner, so actually a genuine employee. A salary is a tax deductible expense no matter who it goes to, as long as it's reasonable and in exchange for services performed. So you as a director running, growing the business, managing the portfolio, you can pay yourself a salary which is going to come off of your profits and save you corporation tax at anywhere between 19 and 26.5%. With a director salary, still the most tax efficient salary to be taken is the 12,570. It honestly feels like I've been saying this number for years, and that's because I have, as we know, personal allowances haven't been increased with inflation, and it's looking that way until I think 2028. So we'll probably be saying this number for another 3 or 4 years yet. 12,570 is the most tax efficient salary. There's no employees' national insurance on that. There's no income tax if you've got no other income. But the company might have to pay employers' national insurance over the new £5,000 secondary threshold if you're the only employee on the payroll. But 15% national insurance on the over 5,000 is still less than the corporation tax rate, so it's still tax efficient to take this. But of course, if you've got a spouse who's maybe not working, they've got some of their basic rate band or personal allowance free, absolutely get them doing a little bit of work in the business, helping with the admin, helping clear a site, look at Rightmove, whatever you can justify, because that's going to allow you to pay them a tax efficient salary and reduce taxes in your company even further. Another fantastic one, which is massively overlooked, is pension contributions. Now, a lot of people, especially younger people my age, you don't want to be putting money in pensions. You're tying it up for the next 25 or so years, maybe even longer if the ages increase, which they probably will do. So it doesn't seem like a good thing to do, because you've got the good thing about a property company is you've got the money there if you need it. You don't mind paying a little bit of tax, but with a pension, it's locked up for God knows when. You really can't touch it unless you have some kind of life-altering disease where you've got a short life expectancy. So for the vast majority of people, they don't like pensions. But for people that are watching this that are slightly further in their journey of life, so to speak, if you're 40, 45, well, actually pension contributions are a great idea, because the pension limit is actually not so far away. You're planning ahead for 10 or so years' time, so you can justify it. You can make sense to put money into a pension because it's so tax efficient. Each year you could put up to £60,000 into your pension, and that's fully tax deductible. So to give you an example, if you had £60,000 worth of profits, paying tax on that, about 20% roughly, what you'd end up doing is actually making that pension contribution before the end of your year. That would reduce your profits in the company to zero, and as a result, the company wouldn't pay any tax at all. You don't pay any income tax. There's no national insurance on putting that money into a pension, which you can then use for pretty creative things as well. So if you've got an ordinary pension, you can buy stocks, shares, you can speak to an IFA, look at SIPs and SASs, because there's a lot you can do with those, especially even investing in property with a pension. We've got clients where they've got a SAS and they could do part developments, lock in a lot of gain, then move it to their development company, finish it off, get a massive tax-free uplift, and also loan backs as well. If you've got a SAS, you can potentially borrow 50% of that to invest in property. There's so many different creative things you can do that actually, for a lot of people, a pension can be a great way to save tax now and also build wealth in a very tax-efficient way too. And of course, if you've been a member of a pension scheme for the past couple of years as well, you can usually backdate those pension contributions 3 years and make a massive lump sum now, especially if you've got a trading profit. If you've got a trading business with a large profit, pension contributions can be a great way to get a massive saving in your tax bill now. Of course, you've probably got a letting agent, you've got a managing agent, they're looking after the property. What about their fees? Can you get a tax write-off on those? Absolutely. It's an expense that you've incurred for the purpose of your business to generate profits. Then as a result, it's only fair, it's only reasonable that you can actually write this off for tax purposes. So any fees you pay to a letting agent, you can absolutely claim this as an expense. Another huge one that we see missed a lot is home office expenses. So as an individual, as a business owner, you're probably working from home quite a lot. You've got a designated room in your house that you use for your office. You've got all your paperwork in there. And what can you claim for this? Well, there's 2 ways you can do it. You've got the flat rate, which is good for a lot of people if you don't want the aggro of calculating it. If you don't spend a substantial amount of time actually working from home, the flat rate is £6 a week, £312 a year. That's an expense, goes to your director's loan account, so the company can repay that to you tax-free. And it's a pretty easy one that we claim as default if you don't want to keep all of the bills, you don't want to get set up a tenancy contract in the more formal way of actually calculating your bills as we're about to cover. So you've got the £6 a week flat rate. What's the other option? Well, it's actually to claim a proportion of your household bills. So if you've got a property where you use a designated room for your office, you can calculate what bills you can attribute to using that room as an office. So that might be some of your mortgage interest, your lights, heating, broadband, whatever it is. You can basically add up your total costs that you can attribute, whether that's on a room by room basis, square footage, time used. There's no set guidelines for this. As long as it's reasonable, it's claimable. And then what you do is get that number of what your household bills are that you attribute to that, and then you simply rent it to your company for that amount. You need to draw up a contract. It's got to be a non-exclusive license to occupy, so it doesn't impact your PPR. But the end result is that you can charge the rent to your company. Your company pays it to you. You've also got expenses which are offset against that. So as a result, on your self-assessment tax return, you show no profit on that rental income, but the money's gone from the company to you personally. The company's saving tax on it. The money's in your bank account, and you've saved tax and got money out tax-free. That's the way to do it. So if you are working from home a lot, you've got a large property, you've got a proper home office, you probably want to go for the actual costs method because it's going to save you more tax. Pocket money. Now, this is a great one, especially if your children are actually helping in the business. So if you've got social media, a lot of kids these days, they manage the social media when we're working with clients to get, the kids do all the Facebook marketing, all the DTV stuff. They do all the Facebook management, the Instagram and everything else because they're whizzes with that. So if your children are doing any form of work in your company, whether that's when you get a property, they might help come clean the site, they might be stripping wallpaper, whatever it is. If your children are genuinely doing some work for your business, then you can pay them tax efficient pocket money through your company. So it's got to be market value. So you can't pay your children £50 an hour for managing social media because that's a little bit high. You've also got to bear in mind that depending on the local authority, there are age restrictions in place. I think it's minimum 14. Usually to keep things simple, we say 16 years old to pay them this pocket money. They've got their personal allowance, so they won't be paying any tax on this personally if it's under the 12,570. But if they've got the national insurance number, stick them on the payroll, and you can pay them that pocket money tax efficiently as a genuine business expense for the work that they're doing. So the kids are happy, you're happy because you're saving tax. And then travel costs. So as a lot of property investors, you're going to networking events, you're viewing properties, you're meeting your accountant, whatever it is, anything that is incurred for the purpose of the business. So you're going to a networking event. You're not doing that for fun. You're doing that to build the property portfolio up, to learn new strategies, to meet other investors. And as a result, all of that's always a tax deductible expense. And if you're taking public transport, well, actually planes, if you're going overseas to property masterminds, that's all the rage these days. That's an allowable expense. If you're getting trains to London, allowable expense. If you're using your own vehicle for business use, you've still got that 45p a mile for the first 10,000. Then after that, 25p a mile. But if you do find you are doing a lot of personal mileage and you're happy to get a tax efficient car, even though you've got a property investment company, you can still use the normal loopholes and reliefs that are available, such as the tax efficient company cars. We've got a separate video on that on the channel, all about what company cars are tax efficient. Cut long story short, electric and hybrid are still pretty tax efficient. So if you are doing a lot of mileage and you want a designated company car, go and check that video out because that's a great way to save taxes. And then the last one, any form of training and development expenditure. So with training costs, it can get a little bit complicated because HMRC argue that, well, actually, if it's a capital expense, which basically means you're learning a brand new skill, then that itself isn't a tax deductible expense. But if you're simply updating it or doing a course to basically make you do your job better, then that is an allowable expense. So say, for instance, you are doing property refurbs and you do a basic plastering course because you want to have a go at doing it yourself, that would be an allowable expense because you're not going to become a plasterer. It's actually just going to help you do the refurb, do your work in the property business that bit better. The same is true of if you do property training courses, learning the new strategies, learning how to grow your business and everything else, that is tax deductible. And equally, shameless self-promotion here, but the Tax Smart Club, actually, that is a tax deductible expense. So you can put that through the company accounts and you can get corporation tax relief on that for that membership because it's teaching you how to pay less in tax, grow your business, build wealth, and actually it is a relevant business expenditure. If you weren't in business, you probably wouldn't be a member of that because, well, for one, you wouldn't be paying that much in taxes, you wouldn't be keen to learn about it. So any form of training and development expenditure, that is tax deductible as well. So there we have it, guys. These 9 tax deductions can massively help you reduce your corporation tax and keep more of your hard-earned money. What ones are you guys already claiming? Did you pick up any new ones? Let me know in the comments. I'd love to hear from you guys. Bye for now.